Investing comes down to two pieces. You have portfolio construction, what assets do you want to own? And then you have portfolio management, ongoing. What decisions are you making as the world changes and markets move? And rebalancing is a key component of ongoing portfolio management. You need to decide ahead of time, how are we going to rebalance this portfolio? Because in any portfolio, you have a number of different assets. You may have US stocks, international stocks, large stocks, small stocks, bonds, short-term bonds, long-term bonds. All of those assets move differently every single day. As the market ticks up and down, they're all ticking up and down to varying degrees. And so you just naturally drift from the initial asset allocation that you made. You made your initial portfolio construction decisions, and over time, you drift from those. And so rather than in a panic or on a whim saying we need to rebalance right back to target, you should have a plan going in on what will happen, what is my rebalancing methodology. And there's a lot of different ways to do it. Calendar-based is probably the most commonplace. Okay, once a year, regardless of how these assets have drifted, how they've moved, we're going to rebalance right back to target. At TruePoint and Commas, we do it a little bit different. We have drift-based methodology. And so we're looking at client portfolios every single day. And we have these predefined parameters where if an asset's performing really well, it can drift upwards. If an asset is underperforming, it'll drift below target. But these overarching parameters say, once you hit either on the high side or the low side, these bands, that's when we're going to rebalance. And so not only does that keep you from straying too far from your initial intended target, but over time, there's the potential that it can boost returns. If an asset's performing really well and you're drifting towards the top end of that guardrail, and if an asset is underperforming and drifting towards the bottom, and you wind up selling the overperforming asset to buy the undervalued asset, getting both back in line, rebalancing in that way can be a systematic way of selling high and buying low. It's definitely a risk reduction mechanism. Imagine if you were a 50% stock, 50% bond targeted portfolio 10 years ago, and now the market has increased rapidly over the last 10 years. And if you never rebalanced, you might be more like 80% stocks and you'd be taking on a lot more risk. So rebalancing first and foremost is risk reduction to keep you from straying too far from your intended target. And it has the potential to be additive to returns because you are systematically selling high and buying low.